I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer Gold Mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
We're chatting with Bob Hoye. He's a market historian and the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, good morning, Jim. Good to be with you.
Well, as we're getting closer to Canada Day and the 4th of July, how are the Canadian and U.S. dollars doing?
Well, the U.S. dollar was in a decline since about the first of the year, and on our work on what we call it the DX, 96.5 level was possible support for it, and it came down to a bit below that. But the key thing is that it gave some technical signals as it approached the low. So we figured, okay, we had been looking for a bottom around that level at support, and it's turned up. It's had a couple of rallies, and I think it has to consolidate its gains for a bit. And so I don't see too much move in the U.S. dollar over the next number of weeks, either up or down. Just kind of continue to build a base, because we think the next move up will be quite significant. And now on the Canadian, it's been acting well. You've had some positive feelings about base metals and stuff, and then also the U.S. dollar was acting so badly, so even the Canadian let's call it stability for a while, but the policies of the federal government are far too ambitious and not sound. They're spending money like drunken liberals, and they could teach sailors something. So the longer-term course of the Canadian dollar is down, one on policy problems in Ottawa, or policy excesses in Ottawa. But the other one is that after August, we think that industrial commodities such as crude oil and base metals and lumber prices will be heading down, and that's not very good for Canadian dollar, which has been identified as a commodity currency. So, yeah. For investors in Canada, one should be looking at the fact that the lower grade bonds, junk bonds, have been good performers since February 2016, after that disaster ended. Very good performers, and have reached technical excesses. So our advice is to get out of low grade investments, or low grade bonds, or low grade corporate bonds, or low grade preferreds and stuff like that, and stand aside. You'll have less income, but the place to be, which will make you some money, is in 3 to 4 year maturity investment grade corporate bonds. You get a little more yield out of that over government bonds. But we'd also buy them in the U.S. because by this time next year, the U.S. dollar could be quite a bit higher. So you get some return, you get some safety, and with the shorter maturities at 3 to 4 years, and it should be a good investment for many folks who want to take the turn. And so that sort of there is an opportunity in here because the junk bonds really did get up and give an outstanding performance, and now have given technical excesses, and we would consider just getting out of the sector.
We'll have more with Bob Hoye right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're chatting with Bob Hoye. Bob, oil has gone down since it was at 53. It's down to around $42. Do you see it falling much further, at least in the short term?
No. It's frustrating for those who are not traders. It rallied up. Actually, I think the high was 55, and again gave technical sell signals. And so a few weeks ago, with the decline, I looked at the chart, and 42 level would probably provide support. And by the 42 level, you mean you got that's a range from 42 to 43, but actually it came down the other day to 42.05 and has bounced. So we think crude oil can recover a little, trade sideways through August, and then you have another seasonal force coming in, whereby often crude oil can have quite a deep low in December, January, and that was the case going into 2016 when it fell all the way down to 27 or whatever it is. So there's something intriguing going on, or fascinating going on here with the OPEC guys are believing that they can control oil prices, and it's bureaucratic think talk stuff whereby they all promise to cut certain amounts of production, and that puts the price up. But if you're selling less, you're not making any money out of the deal. You're just being stubborn and trying to push market prices. Well, bureaucrats can't push market prices for too long, and on the other side of it, you've got the wonderful world of shale production in the United States, and these guys can produce at something like $20 a barrel. So they're selling forward into a price that is artificially high, engineered by some idiotic bureaucrats in OPEC. I think it's wonderful, and perhaps last attempt by OPEC to seriously try to manipulate prices. They'll get hit hard on the next decline, which will likely happen in the fall. So it's fun to watch these with the perspective of indifference, just plain analysis. And and then also it would be historical to see OPEC really get embarrassed, and then the street and the media treating them in regard to that hey, you guys are a bunch of idiots. So a last gasp by OPEC, I think.
Well, don't forget too, it was the Saudis who started the oil price war, thinking that they could destroy the shale producers if they brought prices down.
Oh, that was a story that was attached to the steep decline in crude oil where, 2014, what was it, 107? And that's when we had the article in Maclean's magazine calling for two levels, a fall to one-third of the high, which would have been $37, or perhaps a fall to one-quarter of the high, which would have been $27. And so the main driving force behind the decline in crude oil was, an instruction earlier from the decline in natural gas, which was leading on the fracking thing, and so that's quite simply what we used, is that the natural gas fell to a much lower trading regime, and due to the technological revolution, and it was coming into the oil play, and so you've had this marvelous technological revolution of sideways drilling and fracking, and other resources have had the same, as we've mentioned in 1910, and down at the Bingham Canyon, just south of Salt Lake City, Utah, is when the first major large gold copper low-grade copper deposit was put into production, and that was a revolution because hitherto copper had been mined from higher-grade massive sulfide deposits and things like that. So this was a breakthrough, and you know that Bingham Canyon is still mining in that huge open pit, and that's 107 years later. So then in the 1970s, you had Newmont discovered they could mine at Carlin, Nevada, what was hitherto considered to be low-grade gold. So there was the revolution there. And then also with gold, you then had the leaching thing, which was a different type of operation. So what you've had here is just another technological revolution, this time in energy production, particularly, crude oil and natural gas. And it is going to continue. As a resource person watching this, it's fascinating. I love it. It's absolutely great. And it'll be terrific to watch a cartel, an attempt at a cartel, OPEC, crash, so to speak. So I think the fall is going to be quite entertaining in that department.
We'll have more with Bob Hoye right after this.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Bob Hoye. Bob, we have a question from a fine fellow named Mark in Australia. He wants to know your point of view on gold going forward.
Yeah, gold is not trading up to the bulls' expectations, and it performed reasonably well in the first quarter when the U.S. dollar was weakening and gold did go up, but base metals and crude oil didn't perform that well, and silver really did not perform. So, but what you have is gold is a key in the whole financial spectrum, whereby in troubled times, which could arrive this fall, the very careful money goes to the most liquid items. And the most liquid items are short-dated instruments, treasury bills in the senior currency, which is still the U.S. dollar. And then there's the liquidity that gold provides. So that kind of money is not looking for a return. It's looking for a place where you can park and then come out. So we see that if we go into a financial storm in the fall, the investment demand for gold would increase. But at the same time, the U.S. dollar could be firm relative to other currencies. So there's always a place in every portfolio for some gold. But if you're mainly in U.S. dollar terms, you're not going to make much money in gold. And silver, here's the other one, that it's always analyzed to death by fundamental guys. That means they look at supply and demand, and they point out that every year there's a deficit in the supply of silver, but it doesn't matter, because when you're in dynamic financial markets, the gold-silver ratio acts like a credit spread. Let's call it the metallic credit spread. So when you're in boom times, the gold-silver ratio goes down, silver outperforms gold. And when you're heading into troubled times, it can be warned ahead of by changes in the gold-silver ratio where it starts going up. And it's been going up for, a few months now. And so in a possible storm in the fall, one of the indicators of trouble will be silver on any day doing a very rapid drop relative to gold. We could have gold down a bit and silver down a lot. And now that, I don't know how the gold-silver ratio knows it, but that's the way it acts. So we wouldn't be holding any silver or silver stocks into the fall. It'll be a storm. So here's the other one you can look at, as we describe it, look at gold and gold stocks, particularly gold stocks as an investment, whereby with the real price going up, the mining costs are in line then, and the sector could make some money. But you have a problem here whereby this fall the markets could be heavy, the stock markets could be heavy, and so then we have what we call our comfort level in investing in gold stocks, where you want to have the price of gold stocks outperforming the bullion price. That's not been happening. And the other one you want for a good rally in the gold stocks is that silver should be outperforming gold, but that's not happening, and it's not going to happen until, who knows, maybe the end of the year. So unfortunately, gold stocks may not do well this fall, and so we're not excited about the sector, but we could get excited about watching the gold-silver ratio make a move as a indicator on approaching troubles in the financial market. So, and this then goes back to what I said earlier, where the credit spreads, the difference between high-grade and low-grade bonds, has changed trend towards adversity. And the other one in the credit markets that will confirm the trend towards adversity would be the yield curve, which is the difference between long-dated and short-dated bonds. It's not yet changing. It's still positive for the markets, but it's in a condition where it could change. So, we can't get excited about gold stocks here, and we would avoid silver stocks.
Bob, thank you so much for chatting with us.
Yeah, Jim, it's always good to do our little conversation.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network.
You can forward questions to the show or to Bob to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.